Real estate, dream or trap? So here is the standard blueprint, right, that we already spoke about it. Buying a property, pay off the mortgage, buy a land, build a house, sell for a profit, and then just repeat. On the paper, it sounds all reasonable, but the exact strategy traps investor in place for years. So we're actually going to calculate, is it real profit or not? And, the thing is that I hear this a lot, and probably you can even tell me whenever you speak to someone and they seem like very successful, and some of them would share, oh, you know what, I bought this property, I invested the money, and then I sold it, and I made so much of the profit. All right, so I think we hear a lot of stories like that, but the reality is that they actually made the profit, or they didn't. Until you sit down and you calculate, there's a lot of things that go into the calculations, and I'm going to share this with you today. So how to in reality calculate if you are making the profit or not. We'll see which one will actually accelerate the financial freedom. Is it buying a house or is it buying apartments? Real case study from real examples working with my clients. So I had this one client, he decided to buy the land, do the construction, and then sell it. So this whole thing took him 2 years. He sold the property for $900,000. And obviously, thinking, wow, that's such a great deal. If someone you will just meet and they will tell you, you know what, I had such a great project. I purchased the land for 150. I spent 400,000 on construction. The whole thing was $550,000 over 2 years, right? Sounds amazing. And then we'll sold it for 900,000. We made $350,000 in profit, right? If you just hear this, sounds great, right? Would you invest in this kind of project? I mean, think it all sounds very great, but let's actually identify and see if this is great or it's a hidden iceberg. Then we do not see all the things that happening underneath. $350,000 in profit. So 2 years of lost time, 2 years of project management, 2 years of fighting contractors, 2 years of massive risk, and 2 years of frozen capital of $550,000 trapped. I mean, in his opinion, he didn't take a mortgage. He invested his own money. He did all the construction. He was fighting the contractors, getting the cheapest prices, buying the cheapest supplies, cheapest appliances, overseeing the project, fighting with the attorneys, architects, like this 2 years of time. So if you're doing it yourself, in reality, is it an investment or it's like a self-employment opportunity? It's like a job that you're buying for yourself. So that's one way of looking at it. If you're investing and giving your money to someone who is doing this whole project. So again, that's another way of looking at it, because 2-year period of the time. So that's another thing to calculate. And there's a lot of things that can be risky, unpredictable. That's exactly what happened in this case situation. So the whole project actually took him like a year and a half, again, because you have to get the permits, you need to go through the inspections. So there is a lot of the things, a lot of the components that you are dependent on. And even though if you're estimating for the whole project, like this person, he estimated the whole project is going to take him 1 year. In reality, it actually took him 2 years, getting all the inspections, finishing the project. And then at the same time, by the time he finished the project, the economy turned around and he wasn't able to sell the house right away. So sometimes you can even get stuck for 2-3 years. So whenever you hear these amazing opportunities that someone is presenting to you, these are the things that you need to keep in consideration and write down all the numbers. Because when someone is presenting to you, oh, you invest 150,000, you invest 500,000, and then I can get nice returns in 2 years. There's no guarantees. This is all projections. And this is what's important to keep in mind, that these are all projections. So, and then in this case, if that $550,000 was in a scalable asset, what could it have earned in 2 years? So that's kind of another thing to keep in mind. If you are investing somewhere what else you can do with this money for that period of time. What other opportunities do you have to invest for this period of time? So these are all the things that are very, very important to consider, as well as the taxes, because another component, and now I see that I forgot to mention in here, is also $350,000 in profit. This is all great. But now on $350,000, now you have to pay the taxes as well. And talking about, as we already mentioned, we spoke about Section 1031 exchange. So here is the thing. If you just buying the land and then you're doing the constructions and then you selling the project, then the Section 1031 exchange is not going to be working here. So then unfortunately you will have to be paying taxes on $350,000. And here is another thing also to consider. If you're in this development project and the development of the real estate, then this $350,000 profit is not even considered as a capital gain. This would be considered as ordinary income, meaning you're probably thinking, okay, Ella, what are you talking about? Okay, but the difference between capital gains, obviously with the capital gains, there's a short term and a long term. So with the long term capital gain, you pay less taxes versus with the short term capital gain. But the difference between capital gain and ordinary income is that on the ordinary income, you pay higher taxes. If with the capital gains, we have 5%, 15%, or 20, like the highest is the 20% you can pay. With the ordinary income, the highest you can actually pay is 37%. And then if you are in the development and construction business, then you're also paying a self-employment tax. So these are all the things that you need to consider in terms of the investments of the money. So these are very important components, and you want to consider all of this before you actually invest money into the project. Why? Because this will identify how much you're going to put into the pocket after the investment. So unfortunately, not many individuals calculate all of this. So that's why I always share that it's very important to identify and analyze all the numbers before you invest. So this way you can even identify, does it even make sense for me to invest into this opportunity or not? So these are some important things that I wanted to share. What I also wanted to talk about in this particular case, right? So that's another, again, mistake, if we were to say that this investor made, is that when he invested into this whole project, he used all of his money. So he was so proud of it, is because, you know, he proud that he had the money. He had money of 550,000. He didn't have to take the mortgage from the bank. He didn't need to invest in the bank. And I even remember when I was speaking to him, he was so proud and said, oh, I did everything without the mortgage. And it was great because I didn't have the bank on my shoulders, and I didn't need to worry about paying these monthly mortgage payments. So like on one hand, if you were to look at it, it would kind of make sense, right? Like you don't have all these monthly payments that you have to do to the bank, especially that the whole project took 2 years. Now imagine if you would have to pay the bank for over these 2 years of the period of time, so you would be bleeding cash. So in one way, if you look at it, yes, that kind of seems as a great strategy, smart strategy. But then on the other hand, if you're using your own money, then you're limiting yourself in terms of the growth. Because if you want to grow, then there's 3 components to the growth. And the number one component is use other people's money. So in that case, that would be the bank money. You can use investors' money. So this is using other people's money. You can bring partners, you can do syndications, so that this would be the component of the growth. The second one is you will need a deal, right? So this is what we're talking about. So to identify the deal where you would be investing. And the third component is that you need the deal to produce positive cash flow. So you want to be making money, not bleeding cash and giving it away. So while everyone is always racing and trying to pay off the mortgage, someone else is buying assets, scaling cash flow, and building true wealth. So if you're trying to build real wealth by earning money yourself, making money, and then saving and trying to save on the mortgage, on the interest rate, on buying a better deal with less money, then unfortunately you're not going to be able to build a real wealth.